As a financial advisor, the question I get asked the most is, I have some extra money sitting around. How do I invest it so it actually grows? And honestly, for beginners, that question can feel really overwhelming. There are so many investment options out there, and some of the terms sound like they were invented just to confuse you. Like, what even is an ETF? And when you place an order, should you use a market order or a limit order? What does any of that mean? So today, I made this beginner video to walk you through everything you need to know to start investing this year. By the time you finish watching, you'll have the knowledge to make your first investment and to keep investing for the rest of your life. I genuinely believe these 20+ minutes will be some of the most valuable time you ever spend on YouTube. So please watch the whole thing, listen carefully, and if you can, grab a pen and take some notes. This video has 7 parts, plus a live demonstration at the end. We'll talk about why to invest, how to invest, and what to invest in. I'll also share some simple strategies that work great for beginners. All right, let's get right into it. Why do we invest? There are 2 main reasons. First, if your money just sits in a regular checking account earning almost nothing in interest, it's actually losing value over time. That's because of something called inflation. The U.S. Federal Reserve aims for about 2 to 3% inflation every year to keep the economy running smoothly. And you've probably felt this without even realizing it. For example, a Chipotle burrito cost $8.50 6 years ago. Now it's almost $12. So if you had $50,000 back in 2019, you could have bought 5,882 Chipotle burritos with that money. Today, that same $50,000 only gets you 166 burritos. That's 700 fewer burritos. Why? Inflation. Now, I can think of a few creative ways to deal with 700 extra burritos, but that's not the point. The point is that inflation quietly eats away at your purchasing power. The same amount of money buys fewer things over time. So we have to make sure our money grows faster than inflation, and we do that by investing. Looking at the past 80 years, the overall stock market has averaged about 8 to 10% return per year. So by investing, we can reasonably expect our money to grow well ahead of inflation over time. The second big reason to invest is something you've probably heard before. Money makes money. This idea is called compound interest, and it's honestly one of the most powerful concepts in personal finance. Here's how it works. Imagine you have $1,000, and you earn a 10% return in the market every year. In the first year, you earn $100. Nice, but not exactly life-changing. In the second year, you earn another 10%. But this time, you're earning it on $1, 100, not just $1,000. So now you have $1, 210. If you keep going for 20 years, that original $1,000 turns into $6, 727.50. You didn't do anything extra. You just let it sit and grow. That's the magic of compounding. Now imagine you have $1 million invested and you earn a 10% return. That's $100,000 a year, just from investing. You didn't get a promotion. You didn't work overtime. Your money just did the work for you. The more money you have invested, the bigger your returns become. That's leverage, and it's a beautiful thing. Okay, so now we know why we invest. But the next question is, why should we specifically focus on stocks, meaning shares of ownership in publicly traded companies? Here's the thing. There are lots of ways to invest. You can buy real estate, commodities like gold and silver, or even collectibles like artwork or, yes, Pokemon cards. I'm not judging, but in this video, we're focused on investing in companies, and here's why. It's easy to get started, the long-term returns are pretty reliable, and most importantly, stocks are very liquid. When something is liquid, it means you can quickly and easily turn it into cash. Think about real estate. If you buy a house for $500,000 and decide next week that you want your money back, good luck. You have to relist it, find a buyer, go through the whole transaction process. That usually takes at least 30 days, sometimes much longer. Real estate is not liquid. Stocks, on the other hand, you could buy a share of Coca-Cola in the morning and sell it that same afternoon. Done. Money back in your account. As I mentioned, the stock market has historically returned around 8 to 10% per year. The chart I'm showing here represents the 500 largest companies in the U.S., known as the S&P 500 Index. And in a minute, I'll show you how you can invest in all 500 of those companies with a single purchase. Yeah, just one purchase. But for now, I want you to notice that the S&P 500 generally trends upward over time. There will be dips, there will be rough patches, and sometimes the market just kind of goes sideways for a while. But the long-term direction has always been up. And that's what matters for us as long-term investors. Historically, if you had invested $100 in the overall stock market back in 1980 through an index fund, today it would be worth more than $17,000. And even after adjusting for inflation, meaning $100 in 1980 is worth about $393 in today's money, your investment would still have grown more than 44 times beyond inflation. That's not bad for just leaving money alone. Alright, so we've decided to invest in stocks. Great. Now, how do we actually do it? First, you need something called an investment account. Think of it like a bank account, but instead of just holding cash, it's specifically set up for buying and holding investments. You can open one online pretty easily. It usually takes about 10 minutes. There are a few different types of investment accounts, but the two main ones are retirement accounts and regular brokerage accounts. In the US, retirement accounts include things like a 401k or an IRA. A 401k is usually offered through your employer, while an IRA is something you open on your own. If you live in the UK, Canada, or Australia, I'll show the equivalent account types on the screen. The main benefit of retirement accounts is that they come with tax advantages, which is great. The catch is that the money is usually locked up until you retire. Some people actually love this because it forces them to save. Others hate it because they want flexibility. It really comes down to your personal situation. If you don't want to be locked in, you can open a regular brokerage account instead. Just know that when you sell a stock and make a profit, you'll owe taxes on those gains. Before the internet existed, if you wanted to invest, you had to call an actual stockbroker on the phone. You know those scenes in The Wolf of Wall Street where he's yelling into the phone selling stocks? That's basically how it worked. You needed a broker to place trades because the financial industry is heavily regulated. These days, you can just sign up for an online brokerage account from your couch. Platforms like Fidelity, Charles Schwab, and Robinhood act as your broker. You sign up, fund your account, and from there you can buy index funds, ETFs, or individual stocks. Not sure how to do it? Don't worry. At the end of this video, I'll do a full live demonstration walking through exactly how it works, step by step. Great. So now we know why to invest, why to choose stocks, and how to buy them. But the next big question is, what should we actually invest in? One option is individual stocks. Things like Apple, Microsoft, Nvidia, Google, or Tesla. If you know what you're doing, this can work really well. But honestly, investing in a single company takes a lot of research, and it's usually riskier and more unpredictable than other options. One bad earnings report and your portfolio can drop 20% overnight. No fun. That's why many financial advisors put their clients' money into index funds and ETFs. Because they're simple, well-diversified, and they work. If you invest in them consistently over the long term, the path toward building real wealth becomes much more achievable. Now, the terms index fund and ETF, which stands for exchange-traded fund, get used a lot, sometimes interchangeably. They're slightly different under the hood, but for our purposes today, think of them as basically the same thing. To understand how index funds work, let's start with mutual funds. A mutual fund is when a bunch of investors pool their money together and pay a professional manager to pick stocks they think will do well. The manager charges a fee for this. And sometimes, actually, pretty often, those fees quietly chip away at your returns without you even noticing. An index fund is a type of mutual fund, but without the active manager. Instead of someone manually picking stocks, it automatically tracks a stock index, like the S&P 500, which includes the 500 largest US companies, or the FTSE 100 in the UK. Other well-known indexes include the Nasdaq and the Dow Jones. Because there's no manager making active decisions, the fees are much lower. The fund just mirrors whatever's in the index, automatically. So as an investor, you buy the index fund and you're done. If we look at an S&P 500 index fund or ETF, your money is instantly spread across all 500 companies on that list, companies like Nvidia, Apple, Microsoft, Tesla, and Meta. You're diversified from day one, and your fees are tiny. To buy an S&P 500 index fund, you just need to know its ticker symbol. Think of it like an airport code. If you fly into New York, you might go to JFK. London Heathrow is LHR. Stocks and funds have their own codes too. Those are called ticker symbols. Apple's ticker is AAPL. Microsoft's is MSFT. Tesla's is TSLA. One of the most popular ETFs that tracks the S&P 500 has the ticker VOO. Personally, I love ETFs and index funds because picking individual stocks can get risky fast. Here's a great example. If you had bought Intel stock at its peak price of $72 per share back in the year 2000, you still wouldn't have broken even today. That's over 20 years of waiting and still in the red. Now compare that to the S&P 500 since 2000. It's grown more than 4 times over the same period. On the other hand, if you had picked Nvidia at the right time, you would have absolutely crushed the S&P 500. But here's the problem. No one knows in advance which companies will be the next Nvidia. That's the gamble. So we focus on consistency instead. If you invest $6,000 per year, about $500 per month, into the S&P 500 for 35 years, your investment balance is very likely to exceed $1 million. No, stock picking required. Okay, so now you might be excited about ETFs and wondering, when should I actually start investing? My answer, as soon as possible. A lot of beginners hesitate because the market has already gone up a lot, or because it just hit a new all-time high and it feels scary to buy in. But here's something interesting. The S&P 500 spends about 8.3% of trading days at all-time highs. That's roughly 21 days every single year, where the market is at a record level. And new highs are very often followed by more new highs. If you're sitting on the sidelines waiting for the right moment, you're going to miss some of the best days in the market, and those days matter a lot. If you had missed just the 10 best trading days over the last 30 years, your total return would have been cut in half by 54%. Miss 20 days and you lose 73% of your returns. Miss 30 days and you've lost 83%, all from trying to time the market. Buying at a price that's never been seen before can feel psychologically uncomfortable. That's totally normal. But we have to recognize that feeling, accept it, and invest anyway. Because long-term investing is what actually builds wealth. One of my favorite finance writers is Nick Maguli. He wrote a famous article called Just Keep Buying. His whole point is beautifully simple. Instead of stressing about whether now is the perfect time to buy, just keep buying. Market high, just keep buying. Market low, keep buying. Not sure? Still keep buying. He uses something called the PE ratio, short for price to earnings ratio, to illustrate this. You don't need to memorize the details. But basically the PE ratio is a way to measure how expensive a stock is compared to what it earns. Think of it like a price tag. High PE equals expensive. Low PE equals cheaper. And yes, when you buy at a high PE ratio, your near-term returns might be lower. That makes sense. But here's where it gets interesting. The longer you hold your investments, the less it matters when you bought in. In Nick's interactive chart, as the time horizon stretches from 5 years to 10, 15, 20, 25, and 30 years, the bad outcomes start disappearing. The red dots, negative returns, basically vanish. In fact, in any 20-year period in U.S. history, if you include dividends, stocks have never produced a negative real return. Never. So what that tells us is simple. If you want to build wealth, keep investing consistently. Don't stop. Here's a real-world example. If you search Google for stock market overvalued 2012, you'll find tons of articles from that time warning that the market was 50% overvalued. If you believe those articles and stayed out of the market, you missed the S&P 500, going from around 400 points all the way to where it is today. That's nearly 4.5 times higher. All those, wait, it's overvalued investors missed out on enormous gains. Now, how you invest also matters. You can either do a lump sum investment, putting all your money in at once, or you can use a strategy called dollar cost averaging. Both approaches can work. But I personally find dollar cost averaging to be much easier on your brain. Here's how it works. Instead of investing $12,000 all at once and then lying awake wondering if you picked the wrong week, you invest $1,000 every month for 12 months. When prices are high, your $1,000 buys fewer shares. When prices are low, it buys more. Over time, your average purchase price evens out naturally. This also means you're never betting everything on a single moment in the market. And the best part? You can automate it. Set it up once, and it happens automatically every month without you lifting a finger. No stress, no emotional decisions. Just consistent, automatic investing, the set it and forget it approach that actually works. At this point, you might be thinking, okay, Humphrey, how much money do I need before I start? Some people will tell you to just invest whatever you have, and I get it. But I think the more important question is, can you invest consistently? If you're a teenager or just finished college, and you only have $100 or $1,000 to your name, it might actually be smarter to invest that money in yourself first. Build your skills, increase your income, get to a point where you have a stable paycheck coming in. But once you have a steady income and can regularly set aside some money each month, that's when investing becomes really powerful. For me personally, I started investing when I was earning about $55,000 a year. I was putting in $100 to $200 every month. Whenever I got a bonus or a tax refund, I'd throw that straight into my investment account too. It wasn't glamorous, but it was consistent, and that's what made the difference. Beyond knowing how much to invest, you also need to understand yourself a little bit. And this brings us to the next section, knowing your own investor profile. You need to think about three things: your risk tolerance, your investment goals, and your time horizon. Basically, how comfortable are you with your account balance swinging up and down? Can you see your portfolio drop 30% and stay calm? Or does that kind of thing keep you up at night? There's no wrong answer here. You just need to be honest with yourself. For example, if you're planning to retire in 5 years, your strategy should be much more conservative than someone who has 20 or 30 years ahead of them. When your time horizon is longer, you can afford to take more risk, because even if the market drops, you have plenty of time to wait for it to recover. The key takeaway is this: the younger you are, the more risk you can generally handle. As you get older and retirement gets closer, you should gradually shift towards safer, more stable investments. The reason is simple. When you're young and the market crashes, you still have decades of income and time ahead of you. You can keep investing and recover. But when you're 60 and counting on that money to live, you can't afford to lose a big chunk of it right before you need it. This also leads to a really important point. Investing always carries some risk. It doesn't hand you an 8% return every single year like clockwork. Some years the market flies. Some years it crashes, like during the 2008 financial crisis or the COVID-19 pandemic in 2020. Some years it just kind of sits there doing nothing useful. But if history is any guide, and it usually is, we can expect the market to grow meaningfully over time. Not every year, but over time, yes. Okay, before we jump into the live demo, I want to quickly summarize what I would do if I were starting to invest this year, from scratch. First, I'd make sure I understood why investing matters. That's everything we covered in the early sections of this video. The inflation piece, the compound interest piece, that stuff is your foundation. Second, I'd open a retirement account or a regular brokerage account on an easy, beginner-friendly platform like Fidelity, Robinhood, or Schwab. Third, I'd invest in an ETF or index fund that tracks the S&P 500 or NASDAQ. That's my main set it and forget it investment. I'd automate it and stop thinking about it. Fourth, I'd keep learning. The more you understand about investing, the less scary it feels. Knowledge is honestly the best tool you have. Alright everyone, I hope you genuinely enjoyed this walkthrough on how to start investing this year. If you have questions, drop them in the comments below. I read them. Thank you so much for watching. If this helped you, share it with a friend who needs to hear it, because everyone deserves to understand this stuff. I'll see you in the next one. Alright, bye.